Hello, everybody. Hopefully, everybody's having a great day. Thank you so much for joining us. Hopefully, you're able to hear us clearly and see us clearly. So, we're going to have an interpreter, and I'm excited to go through this information with you guys. I have my colleague, Philip Lamar, also um, going through some of the important information about qualifying for a mortgage, guys. So, basically, a lot of people especially in this crazy times, they are wanting to be in the space for buying a home, and they just want to get more information of what it takes to buy a home. So that's what we're going to cover here today. Okay. So what makes up a mortgage payment? That's one of the first questions that we have, right? Um, well, basically, you have to think about multiple things that go into a mortgage payment, which what we call PITI. So that's for sure, right? You have your principal, you have your interest, you have your taxes, and you have your insurance. So the principal is the amount that's going to be applied towards the principal balance of the loan. The interest, obviously, the cost that it's going to cost you to get that loan. The taxes, we all have to pay taxes. That's one thing we can't get away from. And then the insurance, obviously. So you have to make sure that the property and the loan is insured as well. So those are the things that are going to be bundled into your mortgage payment, right? So if we click on the next slide, now there's different types of mortgages out there, guys, and that's where a lot of people I feel have the most confusion. They don't know, specifically where to go or where to turn. But it's important to start understanding those different types of mortgages. So we have basically your fixed type of mortgages, right? Your fixed rate mortgages, which is going to have a fixed interest rate and it's going to have a fixed monthly payment. So you'll know how much you're going to pay every single month. Here's the thing about the mortgage payment: the taxes and the insurance might vary every year. So your mortgage payment might change every year. Okay. But that doesn't mean the rate of the mortgage might change. And then you also have your adjustable rate mortgages. Now, the adjustable rate mortgages may be fixed rate for a certain amount of years, but then after that amount of years, it might change. Okay, so you have to be prepared for that and know what product you have as well. Now, the loan products that you're going to find out there, there's so many out there, right? But here are some of the most common ones that you're going to find. You're going to have conventional, right? A conventional loan, basically, it's for people that have a little bit more money to be able to put down. Can require anywhere from 3 to 20% down. So you'll see people that talk about putting 20% down on a home on a conventional loan. So that's typically one of the options that you see more commonly. Again, that's for people that have probably the money to be able to put down on a home. Also, they have really good credit scores as well. Now, the other one would be an FHA loan. Now, I'm going to make a distinction between these two right here. So an FHA loan, right? It's a great option for those people that may not have as much money down, right? That typically anywhere from 3.5% down that they're going to have to put down. Now, there is going to be mortgage insurance, PMI, what's called PMI, right? Once you reach 20% equity on a conventional loan, you can actually cancel the PMI. So what that's going to do is going to drop your payment a little bit, but you cannot do that on an FHA loan. Okay, the FHA loan is going to carry the private mortgage insurance for the life of the loan. So that you got to make sure you understand those very good. Then you have your USDA loan. All right, your USDA loan is going to be good for low to moderate income borrowers there. Typically, a lot of the USDA loans, you get those in the rural areas or the outskirts of a city, or a city that's kind of up and coming and is still considered rural. Okay, so also with the VA loans, that's typically for your military, for the veterans. So they have a lot of advantages, but it's a great advantage to know the different types of products that are out there, so you're more informed. Okay, so now understanding on the next slide, it's important to understand affordability, right? Because a lot of people might jump into a mortgage payment and not really know if they're going to be able to pay it. But the good thing is when you're going through the application process, the underwriters are going to make sure that it's going to be affordable. Now, the mortgage lenders are going to analyze basically two things to figure out if you're going to be able to afford that mortgage payment. So the first part of it is what we call your housing ratio. Okay, that determines how much you can afford on a monthly basis as far as payment wise. based on your gross monthly income. So follow me here, and if you guys have something to write down on and some notes, this is something good that you can do. We'll have time for some Q&A at the end, but typically no more than 28 to 30% of your income. So let's say your monthly income, your gross monthly income is right at $4,000, right? And you times that times 28%, that gives you about a $1,120 maximum monthly payment, right? With the PD, the principal, interest, taxes, and insurance as well. So the second part of it, which is going to be on the next slide, right? So it's going to be your debt to income ratio. This is what you're going to hear very commonly out there. This is what the lenders are going to take in consideration a lot more closely, because most people have some type of debt out there. So they're going to determine how much you can afford. So typically that's going to be no more than 40 to 43%. For example, in the product that we provide with Bank OZK, the limit is right at 43%. Okay. So again, you take the monthly income of $4,000 a month. Okay. So you times that, let's just say in this case, by 40%, that gives you $1,600, right? So out of $1,600, that's the maximum you could probably spend on a mortgage payment. But then you have to subtract the monthly debts. In this case, if a family has $600 of monthly debts, let's just say a car payment and a couple of credit cards, then the maximum they can pay on their mortgage is going to be about $1,000. Okay. So that's what you have to consider when you're doing some pre-qualifications and then looking at the numbers of how much you're going to pay for a mortgage. Okay. So hopefully that made sense. And then on the next slide, guys. So basically we're going to get into the steps of the mortgage process. Okay. And I'm going to have Philip Lamar. He's incredible. He's been in this industry for a long time, but he's going to basically explain to you guys the 5 different steps of the mortgage process. So Philip, I'll let you take it over from here.
Sure. I still don't have the slides up, but I'm happy to tell you guys about, it's a great product. We've done it for years. I've been in this business for 10 years now, doing this. I'm trying to find the slides somewhere.
So I'll walk you through them and just explain briefly the pre-qualification process. So what are some of the things on the pre-qualification?
As far as pre-qual, we need, we need credit. We need to know, like their names, their social security numbers, blah, blah, blah. We need
so it would be just basically basic info about the person that's trying to apply. And then the next step after that would just be the actual application. So the pre-qual, that's, help people understand the difference between the pre-qualification and the actual application.
Correct.
Right. So then after the application, then you got the conditional approval, Philip. So if you can just elaborate just a little bit on the conditional approval. So what you were talking about and on the slide that you guys are seeing, I'm sorry that we're jumping back and forth. But on the application process, as Philip was saying, that's where we'll need, your ID, your 2-month paycheck stubs. We're going to need a lot more detailed information so that we can actually send in an application, right? And then Philip, so if you go on the next slide, the conditional approval, Philip. So that's where you'll see the loan estimate. So if you elaborate a little bit on the conditional approval, and then after that, it's going to be the final approval.
Right. So conditional approval is we need 2 months of pay stubs. We need 2 months of tax returns. We need 2 months of bank statements. We need W-2s for 2 years. We need a driver's license. We need, those are the main things that we need to get the loan approved. So right. That's the main thing.
Right. And so with the conditional approval, that's where we see typically that they're going to get a loan estimate, and then on the loan estimate, that's not going to be the final number. So by then we should know how much the loan amount is, all the specifics of the loan that they're trying to get. It's typically 3 pages. And so you're going to see a lot of the information on the loan estimate that can help you basically compare other loans out there and see which one makes more sense for the borrowers. Would you agree, Philip?
I would agree. Yes.
So, and then after
But I think that our loan is better than most loans. I mean, I think that
I agree.
no PMI, no, I mean, we've got a great loan product for sure.
Exactly
So
right.
6% down, 3% down. So,
yep, I agree. So, and then the final approval. So on the next slide. So the final approval, once all the conditions have been met, basically at this point, that's when they'll receive the closing disclosure. So Philip, if you can go through basically the last two steps, which is the final approval and then closing. So once they get the closing disclosures, what can people expect as far as the process goes?
well, the CD, like the closing disclosure, is going to lay out all the information they need to know as far as what they need to pay, all that. We are conservative as a bank, so we always, the loan estimate is always going to be a little higher than the closing disclosure. And yeah, so I mean, or not just a little higher, it's pretty higher. But yeah, I mean, that's, that's the main step. And then goes to, it goes to closing, and then that's it. So
right. And that's when as far as the final approval, that's how people are going to know how much they're going to have to bring to close, as far as down payment, as far as closing costs, all those things, right? So that's going to be on the closing disclosure.
Yeah, and then we have 3 days until we can close, and we can't close before that.
Right, exactly. All right, and if you go to the last step of closing, and then that's where you'll get your keys. So closing, that's you've made it at that point. The closing, if you, Philip, you elaborate a little bit on the closing, like, it takes place at the title company, all those things, you carefully review the documents. So.
Right. So we look at the documents, make sure they're correct, and then we go to closing. I mean, it's 72 hours, and then that's just the federal law. So that's what we have to deal with. But after that, yeah, I mean, 72 hours of business time, and then we go to closing, and the title company gets the docs, and we close.
Right. So it's a fairly simple process, but people sometimes think that it's extremely complicated. So when you're working with a great loan officer, with a great lender, they're going to walk you step by step of exactly what needs to happen and the timing of it as well. But that's basically it, guys. It's just a very simple process that has some moving parts to it. But as long as you are coachable through the process and have all your documents in order, it's going to be a very, very good process for you. So, one thing to consider, kind of going back on some of the things as far as debt to income, this is where a lot of people sometimes drop the ball. And this is where the loan officer can be a good coach in the process, right? So make sure that your debt doesn't change drastically between your pre-approval application process and the closing, because it can affect. We've had scenarios where you're pre-approved, everything looks good, you're about to go into the later stages, and people go buy a bunch of furniture when they know they're pre-approved for the loan. They go buy a bunch of furniture, they get a car and payments, thinking that they were in the clear when that's not the case, right? So you got to keep that in mind. But so I'm sure you've seen a lot of those scenarios too. So, all right, guys. So I think we're gonna have a little bit of time for some Q&A. So if you guys want to jump on and type in your questions, we'll be more than happy to answer. And then Philip, if you see them on there at the bottom, I think we already have a few of them. Are you able to see the questions, Philip?
I am. Let's see here. College student applying for the first time. So we don't care about, I mean, as long as someone's been in school, we're fine. So they've been in school for 4 years, great. If they've, gotten a job after that, that's fine. We just don't like 2 months of, just a gap. That's it. So, I mean, we just can't have that. So that's our thing.
Right. So we have another question. It says, what should my monthly income be to get approved? So Philip, what would you answer to that one?
That's a hard question to answer. I mean, I think it depends on, like what's going on, like
Right.
what's your debt, what's, I mean, it's a hard question to answer. So,
Right. And I would go back to answer that question a little bit, dig deeper into that one. When we look back on the debt to income ratio, you have to look at your monthly income, what debts you have on, on a monthly basis, and then figure out how much you can comfortably afford as far as a mortgage payment. And then that way you can do a pre-qualification with a lender. They'll tell you what you qualify for, or what you can pre-qualify for, as far as the loan amount. Once you have that, if it's 150, 250,000, that's what gives you a better idea of what you can look for as far as a house, right? So the down payment and closing payment is two different payments needed to begin ownership or loan, basically. Right. So the down payment is going to be just an example of numbers. If you have a $200,000 house, right, and you qualify for 3% down, then you typically, the 3% down is where you're going to bring to closing, which is going to bring the balance of that mortgage down. So that's about $9,000 that you're going to bring there. So the closing cost is what's going to cost for actually getting the loan process. So there's two different costs to there. So it's not the same thing. Down payment and closing costs are different, but those are the two costs that you're going to bring to closing. Okay. Philip, are you able to see any other questions there that you want to answer? So we see one good one is, do you need rental history to apply for a mortgage? That's a very good question. So not necessarily. They don't necessarily need to see the rental, but in the case that people do not have what we call traditional credit, that means a good credit score, any of that. If there's no credit score present at all, we specifically, and I cannot speak for the rest of the industry, but we at Bank OZK will work with what's called non-traditional credit, which means if you have 2 good years of rental history, for example, utilities that you've paid on a good basis that you haven't been late on, we actually take those in consideration instead of the normal credit. So that's one thing that separates us from a lot of other lenders out there. So hopefully that answers your question, but it's not required with a normal application there. So somebody says your services. Go ahead.
I would say that typically we need rental history. So
right, for the most part, yeah.
Yeah, I mean, like we need rental history typically.
Right.
So, just know if someone's been paying on time and all that, blah blah blah.
Right.
A lot of it just depends on the underwriter, but yes, I mean, typically we need rental history for sure.
Right.
So,
somebody asked, your service is limited to Dallas County or Dallas only? Are your services limited to Dallas only? And the answer is no. With our specific product, we have a great product, which is a conventional loan with, like Philip was saying earlier, with no mortgage insurance. They can qualify for 100% financing or 3% down or 97% financing, but we can do Dallas, we can do Tarrant, we can do Collin, we can do Denton County, also Harris County and Houston, and there's some other states that we service as well, but it's not limited only to Dallas. Okay.
Yeah, I'm looking at these text messages here. So yeah, we don't do PMI, so it's a bank loan. It's not a traditional conventional loan, so we service the loans ourselves. So you don't have to worry about that. Let me see here.
So it says, are unpaid hospital bills / doctor bills considered as a part of the debt to income ratio?
Well, it's so we do $2,000 up to the first 2 years, and then after that we don't really care. So it just depends on what they're doing. So, but $2,000 up to 2 years, so 24 months.
Right.
Let's see here. We
Would
can,
you say?
so we have a front ratio and a back ratio. We got a 38% front ratio and a 43% back ratio, but we can get past that. Because we need loans. So
Right.
let's see here.
Says, would you say at least 2 years of rental history, even with good credit?
Yeah, $2,000 we allow for like medical stuff. So, we're fine on that. After that, they're going to pay it off or do some sort of, payment program or something. The LE is just an estimate. We don't control that. It's usually pretty high. So, I mean, it's typically $3,000 to $4,000 less than what it's really going to be. So, typically.
All right, and I think those
Sorry,
are some of the. Yeah, me too. And those are great questions on there. All right. I think we answered most of them. Guys, if you have any other questions, somebody said, I have 9 of paying my rent on time. I'm not sure.
Yeah, I don't know what that means. So the only thing we're strict on are late pays. So we do 1 30-day late, and then in the last year, and then 2 30 lates in the last 24 months. So a total of 3. If someone's got a 6-day late, it's a challenge, but we can get through it. Repos we can't do. I don't know what 9 years means, but
I think they meant 9 years, probably.
9 years of what?
Of paying their rent on time. Yeah, that was part of the other question. So they said I have 9 years of paying my rent on time.
Sure. Yeah, that's fine. That's great.
Mm-hmm.
It depends on your credit history. Like, do you have their credit history in the last 2 years? Do you have other things going on? Like, we'll need three things as far as alt credit if you don't have a credit history. That could be electric bills, that could be rent, that could be, insurance. If you don't have that, then, I don't know if we can get that through or not, but, okay, what if you use the estate? We don't do rentals. Yeah, if someone has a rental history from another state, we'll consider that for sure. That's not a problem. Student loans, it's 0.005% on student loans. So it's not 1%, it's 0.5%. Even if they're deferred.
So repositions are under.
Yeah, so like it's only 0.5% that we consider as far as DTI, debt income ratio, for student loan history. I don't know what this question means. Would you say at least 2 years of rental history, even with good credit? I don't know what that means. Yes,
I think it's just referring to the other one. Yeah, just as far as they kind of recapping on what you said, Philip, is as long as they have positive rental history and their credit overall in other areas looks good, absolutely, it's going to help you. So,
yeah, like if you got 2 years of rental history, that's great. And if you've got other things on your credit report, it's at least a year old, 12 months, we got to show that, then we're fine.
Yeah. And to some people, maybe this will clarify, and we just have a few more minutes. It doesn't matter if you have really great history over the last, for example, in this case, over the 9 years. But if in the last 12 months, there's been some negative things on your credit or negative things happening with your rental history, we just look back basically 2 years. Most lenders, depending on the lender, but most lenders are going to look back 2 years. So always keep that in mind. As long as it's just the last 2 years, try to keep all that in order. With W-2s, everything that you're going to need to qualify. So somebody said, how can I begin the process? Basically, you just reach out. I think the answer there. You're going to click on the homeownership counseling. They're going to walk you through instructions on how to do that, but you just reach out to a lender. They can do a pre-qualification. They'll walk you through some information. And that's just how you start the process, right? That's how you'll know if you're sitting in a good place or what you need to do to improve the situation to maximize the potential for you getting a loan.
Yeah. Are there fees involved besides closing costs? Yes, there's a 1% origination fee with our loan, but
Right.
we don't charge anything else. We don't charge, processor fee or any other junk fees. So it typically ends out about the same.
So to answer the question, are there any programs to help with down payment? For example, we have as a bank, depending on the type of borrower, if they qualify at an income level, a lot of the programs that you're going to see are going to be based on income. There is down payment program assistance out there, and it depends on the county. Typically, you just can go online and look for those and apply for those programs. So specifically with our bank, we do have a $5,500 assistance, which can go towards down payment or closing costs, however you want to use that money. But it has to be qualified at the borrower level. So if you make less than 80% of the median household income in the area that you live. So that's one thing. But yes, there's a lot of programs out there.
Well, and also we have, like if it's, if it's a census tract that qualifies, doesn't make sense, we don't care if someone makes $1 million a year.
Right.
It's if it's in the right census tract, then we don't care.
Right. Well, guys, I think we're getting to the end of it, but thank you so much for being on. Hopefully that was helpful. And so we're so, glad to be here and share this information with you guys. So hopefully this is a great and productive year for each and every one of you.